In 2021, a digital image of a rock sold for over $1 million. Not a sculpture, not a painting, a JPEG. A picture of a gray cartoon rock that anyone with a right click could copy to their desktop in under 3 seconds. And in the weeks after that sale, thousands of people bought other JPEG rocks. JPEG monkeys, JPEG penguins, paying tens of thousands, sometimes hundreds of thousands of dollars for files that existed only on a server, because they had watched other people make money, and they could not stand the thought of being the one who missed it. The bubble that followed destroyed billions of dollars in wealth within 18 months. And the emotion that inflated it, the force that overrode every rational instinct in thousands of otherwise intelligent people, was not greed. It was fear. The specific, ancient, neurologically potent fear of being left behind. To understand how FOMO, the fear of missing out, has destroyed more wealth than any single market crash in history, you have to follow it from its evolutionary origins, through the specific psychological machinery that makes it so difficult to resist, into the parade of financial disasters it has powered across centuries, and finally back to the moment you feel it yourself, because you will, and knowing what it is does not make it weak. Chapter 1. The oldest fear in the room. Here's the thing. FOMO is not a product of the internet. It is not something that arrived with social media, or brokerage apps, or 24-hour financial news. It is a drive that runs so deep in human psychology that researchers believe it predates language. The fear of being excluded, of watching others receive resources, status, or safety that you are not part of, activates some of the most ancient and powerful motivational circuitry in the human brain. In the ancestral environment, missing out was genuinely dangerous. A tribe member who was excluded from a successful hunt missed calories. A member who was left out of social alliances missed protection. Being on the outside of what other people were doing was not just uncomfortable. It was a threat to survival. And the brain responded to that threat the way it responds to all threats. With urgency, with pain, and with an overwhelming impulse to close the gap between where you are and where everyone else seems to be. Fast forward to a bull market. The mechanism is identical. You watch people around you, colleagues, neighbors, accounts you follow online, making money on something you do not own. The returns they are describing feel like resources being distributed without you. The social signals around the asset feel like an alliance forming that you are not part of. Your brain does not distinguish between being left out of a kill and being left out of a trade. The emotional signal is the same. The urgency is the same. And the action it pushes you toward, join now, before it is too late, is the same. Robert Shiller, the Nobel Prize-winning economist at Yale who has studied speculative bubbles more systematically than perhaps anyone alive, describes this dynamic as narrative contagion. Ideas about asset prices spread through social networks, the way diseases spread through populations. And the most infectious financial narratives are not the most accurate ones. They are the ones that trigger the strongest emotional response. Stories of extraordinary gain spread faster than stories of ordinary returns. Stories of people who got rich spread faster than stories of people who broke even. And every story of someone else's gain activates in the listener the specific ache of having missed it. Chapter 2. The social proof trap. Here's where things get interesting. FOMO does not operate in isolation. It is turbocharged by a cognitive shortcut that psychologists call social proof, the tendency to use other people's behavior as evidence of what the correct behavior is. In environments of genuine uncertainty, this shortcut is actually useful. If everyone in an unfamiliar neighborhood is running in the same direction, following them is probably smarter than standing still trying to figure out why. Social proof is a heuristic that works most of the time. In financial markets, it produces catastrophe. Because in markets, the crowd is not running toward safety. The crowd is running toward an asset that has already risen, is expensive relative to its fundamentals, and is attracting attention precisely because of the prior price appreciation rather than despite it. Following the crowd in this environment means buying high. The financial equivalent of arriving at the party after the food is gone and calling yourself punctual. The research on this is both clear and uncomfortable. John Kenneth Galbraith, the economist and historian who wrote the definitive account of the 1929 crash in his book The Great Crash, described the final stages of every speculative bubble with a phrase that has aged remarkably well: the bezel. In the late stages of a mania, he wrote, the illusion of wealth becomes self-sustaining. People feel wealthy because asset prices are high. They spend and borrow as if that wealth is real. Their spending supports the broader economy, which justifies the high asset prices, which reinforces the feeling of wealth. The system feeds itself until the moment it does not. And at that moment, the bezel disappears faster than it formed. Think about that. The same social proof that feels like evidence of a real opportunity, all these people making money, all this activity, all this excitement, is itself the mechanism of destruction. The bubble grows because people believe the bubble is real. The belief is the bubble, and the fear of missing it is the air that keeps it inflated. Chapter 3. The historical record. Believe it or not, this is not a modern problem. FOMO-driven financial disasters are among the most consistently documented phenomena in the historical record. They appear in every era, in every geography, in asset classes ranging from tulip bulbs to railroad stocks to dot-com companies to cryptocurrency. The details change. The human machinery does not. The Dutch Tulip Mania of the 1630s is the canonical example, and it is tempting to dismiss it as a historical curiosity involving an unusually irrational population operating without modern financial education. This temptation should be resisted. The people buying tulip futures contracts at prices equivalent to multiple years of skilled wages were merchants, professionals, and aristocrats, the most financially sophisticated actors in the most economically advanced nation on earth at that moment. They were buying because other sophisticated people were buying and making extraordinary returns. The social proof was real. The FOMO was rational given the social proof. And when the bubble collapsed in February of 1637, fortunes accumulated over lifetimes evaporated in days. The same structure appeared in the South Sea bubble of 1720 in Britain, where shares in a company given a monopoly on trade with South America, a monopoly that generated almost no actual trade, rose 900% before collapsing and wiping out investors including, famously, Isaac Newton. Newton, who had sold his shares at a profit early in the run-up, watched the price continue rising, experienced what can only be described as classic FOMO, bought back in near the peak, and lost the equivalent of several $1 million in today's money. He reportedly said afterward that he could calculate the motions of heavenly bodies, but not the madness of people. If FOMO can override Isaac Newton, it can override anyone. The 1990s dot-com bubble followed the same script at a scale only possible in the modern era. Companies with no revenue, no business model, and no coherent path to profitability received billion-dollar valuations because other companies with no revenue and no business model had received billion-dollar valuations and their stock prices had risen. The social proof was overwhelming. The FOMO was everywhere. Between 1995 and 2000, the Nasdaq Composite Index rose approximately 500%. Between 2000 and 2002, it fell approximately 78%. The investors who arrived late, drawn in by the social proof of extraordinary returns, terrified of missing the new economy, absorbed the bulk of those losses. If this kind of breakdown is your thing and you haven't subscribed yet, one tap and you won't miss the next one. Back to it. Chapter 4. Why smart people are not immune. Here's the surprising part. Financial sophistication does not protect you from FOMO. In many cases, it makes the problem worse. Because the more you understand about markets, the more data you can access, the more arguments you can construct, the more frameworks you have available, the more capable you are of building a convincing rational justification for what is fundamentally an emotional decision. Psychologists call this motivated reasoning. You do not start with the evidence and arrive at a conclusion. You start with a conclusion driven by emotion. I want to buy this because I'm afraid of missing it, and then deploy your intelligence in service of building the case for that conclusion. The sophistication is real. The analysis is genuinely complex. And it arrives reliably at the answer your amygdala already decided on before you opened the first research report. This is why every major speculative bubble in history has been accompanied by a sophisticated intellectual framework, explaining why the normal rules do not apply this time. In the 1920s, it was the permanent plateau theory, the idea that modern industrial management had so improved the efficiency of the American economy that the business cycle was effectively over and stocks could only go up. In the 1990s, it was the new economy thesis, the argument that the internet had so fundamentally changed the rules of commerce that traditional valuation metrics were obsolete. In the 2010s crypto boom, it was digital gold, store of value, decentralized finance, the inevitable collapse of fiat currency. Some of these ideas contain genuine insight. All of them were used primarily to rationalize positions taken for emotional reasons. Charles Kindleberger, the economic historian, whose book Manias, Panics and Crashes traced the structure of financial crises across 5 centuries, identified this intellectual rationalization as a consistent feature of every bubble he studied. In his words, there is nothing as disturbing to one's well-being and judgment as to see a friend get rich. And nothing as clarifying to one's intellectual apparatus as the desire to explain why they deserve to keep getting richer, and why you deserve to join them. Chapter 5. The specific moment it happens. Here's the part most people overlook. FOMO does not arrive gradually. It arrives at a specific moment, a trigger point. And that trigger is almost always social rather than analytical. It is not a chart that gets you. It is a person. You hear that a colleague has made a significant return on something you looked at and passed on. A friend casually mentions at dinner that their investment has doubled. You see a post, a screenshot of gains, a celebration of life-changing money, from someone whose financial judgment you have no particular reason to trust. And in that moment, something shifts. The abstract knowledge that markets go up has nothing like the emotional force of a specific human being in your social network who went up. This is where the evolutionary wiring operates at full power. The colleague is not abstract. The dinner conversation is not a data point. They are social signals of the most potent kind, evidence that resources are being distributed, that alliances are forming, that something real is happening to real people you know. And the response they trigger is not, let me evaluate this opportunity rationally. It is, I am being left behind. What follows that moment is a cognitive process that feels like analysis, but is actually defense. You research the asset, but you are looking for confirmation, not evaluation. You read the bull case with attention, and the bear case with skepticism. Every piece of positive evidence lands as signal. Every piece of negative evidence gets filed as bias, or old thinking, or the kind of caution that would have kept you out of every great opportunity in history. You are not doing due diligence. You are doing due diligence theater in service of a decision your nervous system made the moment your colleague smiled across the table. And then you buy, near the top. Because that is when the social proof is strongest. When the most people in your network are talking about it. When the media coverage is most positive. When the narrative is most compelling. When the FOMO is most acute. You buy when the crowd is largest. And the crowd is always largest near the peak. Almost there. If you haven't subscribed yet, hit the button. It keeps this kind of video coming. Last section. Donor. Chapter 6. The only defense that actually works. So, what do you do? If the fear is ancient, if the social proof mechanism is hardwired, if sophistication enables rationalization rather than preventing it, if the trigger is social, and therefore nearly impossible to avoid, what is the actual answer? The answer is not to feel less. The answer is to decide before you feel anything. The investors who consistently survive speculative manias, not by predicting them, but by not being destroyed by them, share one consistent characteristic. They have a written investment policy that specifies in advance what they own, why they own it, and under what conditions they will change. Not a mental note. A document. Something that exists outside their nervous system, written during a calm moment, that answers the question they will face in an emotional moment. Is this something I should buy? Benjamin Graham, the economist and investor who mentored Warren Buffett and effectively founded the discipline of value investing, described this approach as the investor's chief problem and their chief enemy being themselves. His solution was systematic. Decide your criteria in advance. Apply them mechanically. Do not deviate based on what other people are doing, or what the narrative around an asset happens to be at the moment you encounter it. The policy is not interesting. It does not make for exciting conversation at dinner. It does not generate the dopamine hit of catching a trend early. And it consistently outperforms the alternative. Warren Buffett, who has now navigated more speculative bubbles than perhaps any other living investor, has described his approach to FOMO with characteristic plainness. He says he does not know, and does not try to know, when a given market move will end. What he knows is what a business is worth. If the price is below that value, he buys. If it is above it, he does not. He does not adjust this framework based on what other investors are doing, what the momentum of prices suggests, or what the social narrative around an asset happens to be. The simplicity of this sounds almost contemptible until you track what it has produced over 70 years. The second defense is equally unglamorous. Reduce the social inputs. Not eliminate them. That is neither possible nor desirable. But recognize that every story of someone else's gains, every screenshot of a winning portfolio, every dinner conversation about a hot asset is a FOMO trigger operating exactly as evolution designed it to operate. It is social proof firing in an environment where social proof is not a reliable signal. Treating it as data about the investment, rather than as an emotional event to be managed, is how most FOMO-driven losses begin. The third defense is the most important, and the hardest. Make peace with missing things. Not comfortably, not easily, but genuinely. Because the alternative, the attempt to participate in every significant market move, to never be the one who missed it, is the strategy that guarantees you will arrive late to most of them. Pay peak prices for the majority, and absorb the losses when the narrative that made them feel urgent finally runs out of new believers to recruit. In 2021, a JPEG of a rock sold for over $1 million. The people who bought it were not stupid. They were human. They saw other people making extraordinary money. They felt the ancient, powerful, perfectly calibrated fear of being left behind. They built sophisticated cases for why this time was different. And they learned, the way every generation learns, that the most expensive emotion in financial markets is not panic. It is the specific, social, evolutionary terror of watching someone else get rich and doing whatever it takes to make sure it does not happen again without you. The crash did not destroy that wealth. The FOMO did. The crash just sent the bill.